If you want to start investing for your future and building actual wealth but don't know exactly where to start, then you're definitely in the right place. While investing itself is simple once you get set up, it's not always easy to know where to start. This is why I have compiled a simple yet detailed list of the top 10 investing options for beginners, and I've also assigned a risk score to them so that you can have a better understanding of the risk associated with each. But without further ado, let's get straight into the video. Number 1 is a high yield savings account. This is the simplest, virtually risk-free way to boost returns on your money. High yield savings account usually tend to give higher returns on your money above what you would typically earn in a checking or savings account. This can be a great place to park your money if you intend to make a purchase in the next couple of years, or also a great place to have your emergency funds in, since this type of account gives its customers regular access to their money. The interest or return on your money definitely won't be as good as the others on this list, but if you're looking for one of the safest ways to earn a little interest on your money, then a high yield savings account is just what you need. And for these reasons, I have given it a score of 2 on my risk scale. Number 2 are retirement funds. Retirement funds such as a 401k should be one of the first places you put your money, because they come with some major incentives that could be beneficial to you both now and in the future. The first and most important one is taking advantage of your employer's match. Most employers offer to match a portion of what you agree to save from your salary for retirement. Therefore, it is absolutely vital that you take advantage of this, because if they are matching your contributions, they are essentially giving you free money, and it's a guaranteed return on your investment. There are 2 types of 401ks. There's a traditional 401k and the Roth 401k. The major differences with these is that the contributions made to a traditional 401k isn't initially taxed and is allowed to grow tax-free until retirement age. However, with the Roth 401k, your initial contributions are taxed, meaning that you won't have to pay any taxes on withdrawals during retirement. Another good thing with these retirement funds is that they are great saving tools due to their automatic mechanism. When you elect to contribute to a 401k, the money will go directly from your paycheck into this account without ever making it to your bank account. Retirement funds get a score of 3 on the risk scale due to their safe nature, the fact that they are managed by professionals, and the ability that some have to shift your portfolio away from riskier assets as you get closer to your target date for retirement. Number 3 is certificates of deposit, or CDs for short. They are yet another way to earn additional interest on your savings in an extremely safe manner. This method, however, will tie up your money for a longer period than that of a yield savings account. Certificates of deposits are a type of a savings account that will have a fixed interest rate and term. How they work is, you essentially lock up a specific amount of money for a specific amount of time, which usually range from 3 months to 5 years, and you earn a fixed interest on that amount for the duration of the predetermined time. But why would you want to do this? And what are the drawbacks to it? Well, you might want to take advantage of CDs if you have a sum of funds that you know you won't need to use for the foreseeable future. The good thing with this method is that you don't have to worry about market conditions or your bank's fluctuation in interest rate, because your interest is fixed and locked in place. The flip side to this, however, is that you could be leaving money on the table if you lock in your money at a fixed rate, and then suddenly your bank's interest rate increases. You are then forced to continue to earn interest on your money, but at a lower rate until your specified period or term has finished. Technically, it is possible to withdraw your funds before the CD matures and the term has finished. However, you will have to pay a significant withdrawal penalty fee for it. As previously stated, this method is another extremely safe way to invest your money and gets a 3.5 on my risk scale. These accounts and banks are usually federally insured up to $250,000. Just be sure you won't need the money for the agreed term length if you decide to invest in CDs. Number 4 are Robo Advisors. So, let's say you've managed to scrape together a little bit of money and you want to invest it, but you either don't know how or would just rather have a hands-off approach with the whole investing situation. Well, you actually can, thanks to Robo Advisors. They manage your investments for you using complex computer algorithms. This is a great way for beginners to start with investing because these services usually require very little money and they do most of the work for you. They actually usually charge low fees relative to human investing managers. Their fees typically cost about 0.25% to 0.5% of your account balance per year. I wouldn't advise you to be completely hands-off because at the end of the day, it's your hard-earned money, so it should be your responsibility. You can, however, let the Robo Advisors do all the heavy lifting as you learn all the ropes on how to invest. Robo Advisors get a 4.0 on the risk scale, as they use complex algorithms to construct your portfolio to best fit your needs, and some even allow you to customize your portfolio to a certain degree. They also provide you with tools and services to assist you and have generally performed relatively well. Number 5 are mutual funds. Mutual funds are essentially a basket of investments. They give investors like you and me the opportunity to invest in a basket of stocks and bonds with one simple transaction. Typically, a professional investment manager chooses how the fund is invested, but there is usually some kind of general theme. For example, some of the most popular mutual funds track indexes, such as the S&P 500, which as the name states is composed of around 500 of the largest companies in the United States. This gives you vast diversification so that all your eggs aren't placed in any one particular basket, but instead has exposure to the entire US market and economy. The fees associated with this type of investments are relatively low and occasionally none, allowing its investors to keep more of the returns on their investments. This can be a great way to build wealth over time and is a relatively safe investment over the course of your career or lifespan, which is why I have assigned it a 4.5 on my risk scale. Number 6 is index funds. Index funds are very similar to mutual funds, but rather than having a professional manager build and maintain your investment portfolio, index funds simply track a market index, like the popular S&P 500 we just spoke of. Since index funds take a more passive approach to investing by simply tracking the market index instead of relying on professionally developed and managed portfolios, they tend to carry a lower expense ratio and fees associated with them. Most brokerages offer a vast selection of index funds with no minimum fee, meaning that you can essentially start investing with as little as $100. Due to its safe nature, their similarity to mutual funds, and their vast diversification, I have assigned index funds a risk score of 4.8. Number 7 on the list are ETFs. ETFs are exchange-traded funds. They operate in many ways similar to mutual and index funds, as they too can hold a basket of securities. However, they trade throughout the day in the same way a stock would. ETFs do not come with the same minimum investment requirements mutual funds come with, which are typically a few $1,000s. But instead, they can be purchased for the cost of one share plus any small fees or commissions associated with the purchase or broker. Some brokers even allow its investors to start investing with even less by allowing fractional shares. Fractional shares allow us, the investors, to purchase, as the name states, a fraction of the share. For example, if X share costs $500, but we only have $100 to invest, we can still invest by buying $100 worth of that share, or essentially 1/5 of the share, instead of having to buy the full share for $500. This allows investors more opportunities to diversify and start investing earlier. This, coupled with the fact that most brokers now offer 0% trading and commission fees, ETFs get a 5.0 on the risk scale, and is a great way for new investors to start investing and dipping their toes with as little risk as possible. Number 8 on the list is real estate. Real estate investing is not something I would generally recommend for beginners due to the hefty startup costs and risks involved if you don't know what you're doing. I had to, however, include it on the list because it is undoubtedly one of the best ways to increase and grow your wealth exponentially and should not be overlooked. With that said, there are safer ways to invest in real estate that isn't the typical home or apartment ownership route, and that's REIT ETFs. Real estate investment trust ETFs allow individual investors to invest in large-scale, income-producing real estates, such as office buildings, apartment, hotels, warehouses, and much more, without actually having to go out and physically buy commercial real estate. This way of investing in real estate, like ETFs, are fairly safe and allow its investors to earn a share of the income produced by the commercial real estate ownership without the hefty lump sum needed to purchase the property. And for this reason, I have decided to place this form of real estate investing at a risk score of 6.0. Coming in at number 9 are individual stocks. Buying individual stocks in an individual company is one of the riskiest, yet most lucrative and rewarding investing options on my list for beginners. Before you run off and start trading individual stocks, there are a few things you need to consider. Unlike indexes, such as the S&P 500, which contains and gives you exposure to a basket filled with different companies, individual stocks are a lot riskier because it's like placing a bet on any one specific horse. If you guess or make a good calculated decision and it plays out good for you, it can be very rewarding. But if it doesn't, then you stand to lose a great deal. This type of investing requires a lot more understanding, analysis, and time, because you need to fully understand and know the individual stock or horse per se that you are placing your bet on. Because a stock is a partial ownership or stake in a business, which means that over time your fortune and misfortune will rise or sink with that of the company you invested in. For these reasons, I have assigned individual stocks a score of 7.0 on my risk scale. Number 10 on my list is cryptocurrency. The ever-increasingly popular cryptocurrency is the last one on my list for a very specific yet simple reason. It provides the highest returns by far of anything on my list, but subsequently also carries the highest risk associated with it. Cryptocurrency is a vast and deep world in itself, with a multitude of ways to invest in it, some riskier than others and promising higher returns. But all things considered, I have decided to give cryptocurrency an 8.5 on my risk scale, because as I said, there are numerous ways to invest in crypto, some riskier than others, so I wouldn't advise any beginner investors to invest in crypto without a sound fundamental knowledge of how it works and without doing their own research first. But let me know in the comment section below if you would like me to do an in-depth analysis and dedicated video solely on cryptocurrency, your investment options within it, and how it compares to traditional stocks. But make sure to like the video if it's provided you with any value, and until next time, it's the Mindset Kingdom signing out.